Welcome to Bill the Lender podcast, devoted to educating you on a variety of financial subjects with an emphasis on real estate and real estate finance. Please click the button to subscribe to my channel so you don't miss an episode. Then like and share your favorite episodes. Hello, everybody, and welcome to Bill the Lender podcast. I'm your host, Bill the Lender. And we're following up some of our previous episodes with some updates to, reflect a lot of the changes in the current real estate market. On previous episodes, we've talked about the housing crisis and our inability to build out of the current crisis and why that is. And now we're going to talk a little bit about the shifting and changing market and what is happening that is creating these market dynamics that you as a consumer need to be aware of, whether you're selling your house and buying another, or you're looking to buy your first home or an investment. Now, market dynamics are an interesting thing. Market dynamics play out kind of like life does, where you have an expectation based upon a previous way or past assumptions of how things have been going. And then something changes, something happens. In this case, interest rates have risen dramatically. We've been trying to fight inflation. And that has really put consumers in a bit of a quandary as to what to do, what's the right time. The media is not doing anybody any favors in sensationalizing everything. And so people are looking for a clear direction of where the market is headed and where we're going. So today we're going to talk a little bit about a seller's market and a buyer's market, what market influences are sort of playing out and how they're playing out in these market dynamics. But first, I think it's important to define what the difference is between a seller's market and a buyer's market. I want to really start with a seller's market first, because that's where we've been at for the last couple of years. And interest rates is really a combination of interest rates being low, supply being low, as we talked about in previous episodes, and demand being high. When there are more buyers than there are sellers or inventory in the market, the folks who are selling their homes have a unique advantage. And they can demand top dollar, and they can pretty much do nothing to the home and sell it as is, and they can dictate terms. And depending upon where you are in the United States, most of our markets here in the United States are actually in sellers markets. They're transitioning. We're in this interesting period, which is why we're sort of covering it today, where we're looking at more of a buyer's sentiment, buyer's market coming out to play, and what the shift in the dynamics looking like. But in a seller's market, they can pretty much dictate the terms. They don't have to fix any inspection issues. They can do the very, very basic repairs or no repairs at all, and still have folks pay over asking for their property, because housing is at a premium and people need a place to live. Now, what we're seeing as the market begins to shift, and what's happened that's created the seller market in the past, is that rates have remained low, and people's incomes have been increasing. We saw that even through the pandemic and slightly after. Wage inflation has become a thing because employers are trying to get people back to work. And so they're paying a premium for them to come back to work. But now that interest rates are rising a bit, that has people a little bit confused. Generationally speaking, the main buying populace inside the market right now are millennials and Gen Ys. They don't remember the boomers' recollection of interest rates being at 11, 12, 13%. They're really looking back to 2008, 2009, where they saw a sharp decline in interest rates from the sixes all the way down to the low threes and high twos. So their consumer sentiment and look back is a historical view of the interest rate market that isn't necessarily an accurate reflection of where interest rates, average interest rates, historical interest rates actually have been. If you look at the average interest rate over the inception of the bond market, you're looking at an average interest rate of 7.5%, which seems astronomical. But rates right now are in the high fives, low sixes, depending on the product type and the day. And that really has a lot of people taking pause because their historical outlook of the consumer and the majority of the buying populace today just doesn't have a reference for interest rates being at that level. In addition, because we've seen such sharp demand and low supply, it's really created a market where appreciation has continued to take off. The last 5 years, we've seen 70% of Colorado's appreciation. In the last 3 years, we've seen double-digit appreciation, anywhere from 14 to 23%, depending upon the market. That high appreciation plus higher rates have people taking a little bit of pause. But there's this transition in the market, like I'm talking about, where the expectations actually have to catch up to where the market's actually at. And there's two sides of those expectations. The sellers think that it's still a seller's market, so they're still asking listing agents to price at a premium. But the market cannot support that because interest rates have climbed so fast. In this year alone, we've seen rates from January climb from the threes to, full 2.5, 3 percentage points to the high fives, low sixes. That is a drastic increase in payment. I was running some pricing for a client yesterday, and the difference between a payment at 3.75% and a payment at 5.75, depending upon the product, program, pricing, and these types of things, but just interest rate wise, was a $666 difference in payment. It's huge. Now, why this is important? Well, let's talk about cash flow. Let's talk about people's ability, even though, people are making more money because employers are trying to get them back to work. A $600, $700, $800 increase in a payment for housing is a significant dent in your cash flow. So sellers are expecting to price at a premium, but the cost to do so is having consumers pump the brakes. Buyers are saying, I'm not going to pay a premium because interest rates are too high for that. So we're seeing prices start to drop. Now, I would argue that we're not seeing prices decrease. So we're not necessarily in a buyer's market just yet. We'll talk about that subtle difference here in a second. But it's important to really understand the two sides and how these market dynamics play out and how they're currently playing out in the market today, because the media would have you believe that we're seeing price decreases across the board in real estate. And that's not necessarily true. In my mind, what we're seeing is appropriate pricing. We're taking the cream off the top. Prior to the significant increase in rates just this year, we were seeing a 10% premium on top of current market pricing for real estate. So if you were priced at $400,000 and you were going to list your house for sale, listing agents were listing at $420,000, $430,000, $440,000. because they knew that they could probably get that premium because people were paying $50,000 to $100,000 over asking to even get a property. So we're seeing that house priced at 440 because the seller, that side of the consumer populace, is expecting that the market is still going to yield that. But the buying populace is saying, no, we're not going to do that. So the market now sits, the house now sits on the market for 30 days. Now, mind you, prior to this bit of what we'll call a slowdown, the property would be listed and it may not even hit the market, and they'd have 5, 10, 15 offers within the first 24 to 48 hours. Now housing is sitting on average 30 days, which is a big shock to the listing side of the consumer populace, causing a little bit of panic. Okay, so we're going to list it for 40. We're not getting any showings. Now we're going to price appropriately at 400,000, which is actually really the market. So are we seeing a decline in pricing? I would call it the cream. We're taking the cream out of the market. We're taking that extra premium out of the market. Now we're not seeing as much demand because, again, interest rates have risen so fast. The media is saying we're headed into a recession. Typically, when those types of things happen, people think that there are going to be a ton of deals hitting the market soon. So they're sitting on the sidelines, waiting to see how these market dynamics play out, which kind of gets us into a little bit of a conversation of a buyer's market. But before I get to that, I want to talk a little bit about why I think it's important. And again, we've covered this in previous episodes, that we're not going to see a sharp decline in depreciation, regardless of whether or not we go through a recession. And it's simply this. We currently have a housing shortage of 5.5 to, in some analyst cases, 6 million units per year. And the entitlement process is taking twice as long, so we're not going to build out of that. And all the existing inventory, part of that problem is 30% of that is being bought up by institutional investors and turned into rental housing. So you have all of these things that are actually going to keep supply in short so that demand is going to continue to be high. Now, the other thing that I see coming is that typically, historically speaking, when you track interest rates, which I do because I'm a nerd, but when you track interest rates through recessionary periods like we are potentially about to head into, interest rates fall throughout a recession. And in all cases, the Federal Reserve has said that they're going to aggressively fight inflation. And every time they've said that, and I've covered some of this in previous snits and video series that I've done, not necessarily on the podcast. But when you look at this, inflation is always transitory before they decide to do something about it. Then they decide to fight inflation. They raise the Fed funds rate, which is not interest rates, but it's the rate at which banks borrow and lend money back and forth. They raise that cost of borrowing money. We head into a recession, and then the economy slows down and interest rates fall throughout the recessionary period. So it's really hard to say if we are necessarily going to see some of the buyers markets that we've seen after 2008 in the foreclosure market and those types of things. There's certainly nothing to suggest that there's going to be a glutton of inventory on the market unless these institutional investors panic and they decide to dump all of their inventory on the market. Then that could potentially see the same impact. But these institutional investors are institutional investors for a reason, and likely they will buy to hold regardless of the market. They have the resources and the capital not to panic, not to sell off loads of these assets at a time to cause a market correction or a crash. If that is true, then if rates fall, then because we've seen an increase in people's earnings and interest rates are now falling into more of an affordable range, it should continue to support pricing. In addition to that, you also have the demand issue that I've already addressed. Supply is going to continue to be tight as long as those institutional investors don't dump a surplus on the market. So we are seeing signs of a buyer's market. So let me talk a little bit about that, because the strategy in a seller's market and the strategy in a buyer's market is very different. In a seller's market, from the buying standpoint, it's very, very important that you get pre-approved beforehand, because nobody is going to consider your offer serious unless you've already spoken to a lender, you've already been pre-approved, you've already verified all of the assets and the credit and the job history required for closing, so that they know when they list their house that you have the highest likelihood and potential that they're going to close on the contract date and they're not going to have to relist this property. But in those types of markets, should that happen and should you fall out, they can list for higher because the market continues to appreciate while you're under contract, which is what makes sellers markets like the one that we've been in really, really stressful for buyers. It's that need to perform right now. And that's why having a relationship with a good realtor and a good mortgage lender is critical. Now, on the buyer's market, the pre-approval is important. It's still important that you execute, but the seller is more likely that they're going to work with you, okay? They're probably going to pay your closing costs. You might be able to offer under list price. If you have any delays in the financing process, there's a good chance that they're going to work with you and allow you the time to figure it out. In a seller's market, you can't perform, they're cutting bait, and they're moving on. So the ability to have that flexibility of a buyer, as we're seeing these rates sort of increase and the market's not quite sure what it wants to do, where it's going. People are on the sidelines because they're expecting deals. Well, typically, I think this is going to be more of a regular market cycle. If you don't remember, because short-term folks don't necessarily remember what a healthy market appreciation is. It's between 4 and 6%, and that's where I think that we're going. That is way more sustainable. That creates more of a balanced market where not one side is taking advantage over the other. And those are the types of market dynamics that are much easier to work in, because the seller is not afraid to list their home, which has also been contributing to this tight inventory, because they know that there's housing available and they can upgrade, they can move up, they can move down, they can do what they need to do. A buyer knows that they have a wider variety of homes to choose from. They don't have to settle, right? Just so that they can find housing and maybe make a lateral move instead of actually moving up and expanding the room for their family that's required because they've had another child or they're relocating from another city. So a balanced market is where I believe that we're heading. And all intents and purposes certainly suggest that, at least for the short term, that's more likely. In fact, what we're seeing is now that housing is starting to sit on the market for longer, we're seeing less competing offers. Now, I will say this, if it's a premium property, you're still going to compete, still, even today. You still may be over asking, still, even today. So if it's a premium house in a premium location, there's still that demand, which suggests that we're not entirely in a buyer's market. And again, a buyer's market adds that flexibility, but it technically is defined as when there is more supply than demand. And we don't really have that. So we're not technically heading into a buyer's market, which is why I suggest we're heading into a balanced market. So those are some of the basics of the types of things that we're seeing, the difference between a buyer's market and a seller's market. And I hope this has been informative. This is Bill Rodriguez with Build a Lender podcast. Until next time, we'll see you soon. Thanks for listening to Build a Lender podcast. Please reach out to me with any questions at 303-877-6323.